In today's video, you'll learn something that can really help you. So like it and subscribe so you don't miss the next ones. Let's get started.
Imagine waking up one day and discovering that the secret to building one of the greatest fortunes in history was not a risky bet, a revolutionary technology, or a stroke of luck. Imagine discovering that the answer was hidden in something that almost everyone completely ignores: time. It sounds too simple to be true, and that is exactly where the problem lies. Every year, millions of people enter the financial market with their eyes full of expectation. They have heard stories of people who double their wealth in weeks, watched tutorials promising financial freedom in months, read posts from profiles showing absurd gains in an extremely short period of time. And then they all do the same thing. They bet everything on speed. They buy assets that went up a lot yesterday, expecting them to go up even more tomorrow. They sell at the first drop. They jump back in when the market starts rising again. They repeat the cycle until the money runs out. And when they add everything up at the end of the year, they realize they lost not only capital, but something even more valuable: the time they wasted trying to be fast. Now look at Warren Buffett, a man who, at 93 years old, accumulated a fortune that exceeds hundreds of billions of monetary units in global value. A net worth that places his name among the greatest investors of all time, in any country, in any era. But here's the fact no one tells you. More than 96% of that fortune was built after he turned 65 years old. Read that again. It wasn't in his youth. It wasn't a brilliant move in his 30s. It wasn't a moment of illumination or privileged access to secret information. It was after 65. After decades, after a level of patience that most people will never be able to practice because no one teaches that patience is, in fact, a strategy. This raises a question that will stay in your head for a long time. If Buffett knew from early on how the game worked, why did it take so long for his wealth to explode? What was happening in the previous decades that prepared the ground? And what exactly accelerated everything after 65? The answer is not in the stocks he chose. It's not in the sectors he favored. It lies in a principle that most people know by name, but that almost no one truly understands in practice. And understanding this principle completely changes the way you see money, investing, and the very concept of building wealth. Before going deeper into this, one fundamental point needs to be established. The biggest mistake beginners make is not choosing the wrong asset. It's not entering at the wrong time. It's not even having little capital to start with. The biggest mistake is believing that wealth is about intensity, when in reality, it is about duration. And this distinction, seemingly small, separates those who get there from those who fall by the wayside. The book The Psychology of Money by Morgan Housel brings a piece of data that summed up decades of behavioral analysis in a single devastating observation. Most people fail in investing not because they make wrong decisions, but because they abandon right decisions too early. Buffett did not get rich by being the smartest investor in the world. He got rich because he was the most persistent, because he built a foundation early on and, unlike almost everyone else, did not destroy that foundation at the first scare, the first correction, the first moment when the market turned its back on him. And here's something even more intriguing emerges. There are other investors who had higher annual returns than Buffett in certain periods. Brilliant minds, sophisticated strategies, impressive results over specific time windows. But none of them got where he got. Why? What did they have that was different? Or rather, what didn't they have? That question will be answered, but not before understanding the invisible mechanism behind all of this. A mechanism that was not invented by economists, was not discovered on Wall Street, and does not appear in any technical analysis spreadsheet. It was first observed in something completely different: the climate changes of planet Earth over tens of thousands of years. If you're enjoying what you're seeing so far, subscribe to the channel, like the video, and leave a comment saying what you thought and which city or country you're watching from. This helps the channel grow a lot and bring more content like this. Ice ages did not begin with a devastating winter. No epic storm. No sudden climate catastrophe triggered periods that lasted tens of thousands of years and reshaped entire continents. What happened was something far less dramatic, and for that very reason far more powerful. Summers were just slightly cooler than normal. That's all. Slightly colder summers. No glaciers falling from the sky. No extraordinary events. Just summers that were unable to completely melt the snow from the previous winter. And what remained, that thin layer of ice that resisted, became the base for the next winter to accumulate more. And then more. And then more. Until the weight of that silent accumulation transformed the planet in an irreversible way. This is the exact mechanics of compound interest. It is not a force that appears out of nowhere. It is not an event you can point on a calendar and say that was when everything changed. It is a constant pressure, almost imperceptible in the short term, that becomes impossible to ignore in the long term. And like any silent force, it demands one thing the modern world trains people not to have: real patience. Not the patience of speeches, but the kind that withstands pressure when everything around you signals to get out. Buffett understood this at 11 years old, when he made his first investment. But understanding was not the differentiator. Many people understand the concept. What separated Buffett from everyone else was what he did next. He never stopped. He never sold everything in panic. He never abandoned a position because the market became irrational for a few months. He never destroyed the ice base he had built. And here comes the turning point that few truly manage to internalize. Most people who study investing look for the right method, the perfect strategy, the indicator that never fails. And there is an abundance of systems, formulas, and tools available for those who search. The financial market has never lacked theories. What it has always lacked are people capable of applying any theory for long enough for it to work. Because the market does not test your intelligence. It tests your psychological endurance. Buffett held Coca-Cola shares for more than 30 years. During that period, the company faced crises, boycotts, changes in consumption, corporate scandals, and moments when it seemed the product had lost its cultural relevance. In several of those moments, the rational decision, according to short-term analysis, would have been to exit, reduce risk, reallocate capital to something with a better outlook. But he stayed, and the accumulated return over those 3 decades turned that position into something market analysts still use as a case study in universities around the world. The point here is not that Buffett is stubborn. It's that he was able to distinguish between volatility and real deterioration. When the price of an asset falls, it can mean 2 completely different things: that the asset truly lost value, or that the market became temporarily irrational. Most people treat both situations the same way and sell in both cases. Buffett learned to separate one from the other and act differently in each scenario, with the composure of someone who knows that price and value rarely move together in the short term. This explains why other investors with higher average annual returns than has never reached the same final result. They were brilliant in favorable cycles. But when the market turned, when the scenario became uncertain, when psychological pressure peaked, they exited. And by exiting, they broke continuity. They destroyed the ice base they had built over years of disciplined work. And it is exactly at this point that a question arises that will remain unanswered for a moment. If permanence is more important than performance, then what exactly threatens that permanence? What makes intelligent, disciplined people with access to the best market information abandon solid positions at the most critical moment? The answer is not in the numbers. It is in something that happens before any financial analysis even enters the scene. And truly understanding this is what separates those who survive in the market for decades from those who survive only in the good years. The greatest enemy of any investor does not live in the market. It is not in interest rates, economic reports, or central bank decisions. It lives inside the investor's own mind. and it acts most efficiently precisely at the moments when rational thinking is needed the most. Behavioral science has a name for this mechanism: loss aversion. The human brain has been programmed over millions of years to react to the threat of loss with far greater intensity than it reacts to the possibility of an equivalent gain. Losing an amount generates twice the emotional impact of gaining the same amount. This is not weakness. It is biology. It is the nervous system functioning exactly as it was designed for environments where a mistake could mean death. The problem is that this system, so useful for physical survival, is devastating to financial health. When a market drops 15%, the brain does not calculate probabilities. It enters flight mode. And flight, in a financial context, means selling. It means getting out. It means exactly the behavior that destroys decades of accumulation in a matter of days. And worst of all, this behavior feels completely rational at the moment it happens. The narrative the person builds for themselves is always convincing. They believe they are being prudent, that they are protecting what they have built, that they will re-enter when the market stabilizes. But the market almost never warns when it is about to stabilize. It simply goes up, without ceremony, often at the very moments when most people are still afraid to re-enter. And the person who got out is left watching from the sidelines, waiting for the right moment that rarely arrives in the way they imagined. Buffett went through this many times. The difference is that he had something most people do not: conviction built on deep analysis, not on intuition or blind confidence. He knew why he had bought each position. He knew the real value of what he was holding. And when the market disagreed, he did not collapse. He waited calmly, because he understood that the market is a voting machine in the short term and a weighing machine in the long term. Here's something happens that few people notice in Buffett's trajectory, something that completely changes the interpretation of what it means to be a great investor. In 1999, at the peak of the technology bubble, Buffett was publicly ridiculed. Analysts, journalists, and investors declared that he had been left behind, that the world had changed, that his model was obsolete. Technology stocks were rising hundreds of percent, while his portfolio stood still. The pressure to change strategy was enormous. The dominant narrative said that resisting was stupidity. He resisted. In 2001 and 2002, when the bubble burst and trillions in market value evaporated, Buffett did not just survive. He emerged stronger, because he had never destroyed his foundation. He had never traded decades of discipline for months of collective euphoria. This is the real climax of this story. It is not the moment he became rich. It is the moment he refused the easy wealth that would have destroyed everything he had built. There is a phrase attributed to him that summarizes this principle with surgical precision: the market transfers money from the impatient to the patient. That phrase sounds simple, but when you understand what lies behind it, its weight changes completely, because it does not talk about patience as a passive virtue. It talks about patience as an active strategy, a conscious choice not to act when everything around you screams for action. And that choice has a cost. It is socially difficult to stand still when everyone else is moving. It is psychologically exhausting to maintain conviction when the market signals that you are wrong. It is emotionally heavy to watch others seemingly getting rich while your strategy appears not to move. But that is exactly where the ice base solidifies. It is in the cold, in absolute silence, in apparent inactivity, that accumulation happens. Not in a visible way, not in a way that generates headlines, but in a way that, when time passes and the numbers appear, transforms what seems small into something extraordinary. What Buffett built was not a technique. It was a mindset, and that mindset has a practical consequence that anyone can apply, regardless of how much capital they have available today. Buffett's mindset does not require you to be a genius. It does not require access to insider information, connections in international markets, or an impressive starting net worth. It requires something far harder to find in today's world: The ability to think in decades when the entire environment around you forces you to think in days. And here is the practical consequence that was promised in the previous section. If you take any established global market and observe periods of 10, 15, or 20 years, you will always find the same pattern. Those who stayed won. Not those who chose the best asset of the year. Not those who predicted the crisis most accurately. Not those who exited at the right time and re-entered at the perfect moment. Those who stayed. Those who did not destroy the ice base they had built in the previous years. This pattern repeats itself across different markets, different economies, different decades, and different generations. It is not a historical exception. It is the rule that most people ignore because it does not generate headlines, does not sell quick courses, and does not fit the popular narrative that getting rich requires a brilliant insight or a bold move. Buffett began investing with the equivalent of a very modest amount by today's standards. What he had was not capital. It was time, and the awareness that time, combined with discipline, is the most powerful asset that exists in any market in the world. The lesson is not about him. It is about what he represents. Proof that the system works when you do not try to beat it by force, but instead allow it to work for the time it needs to deliver results. And here lies one of the deepest ironies of this entire story. The people who most need financial freedom are the ones who are least able to wait. The discomfort of their current situation creates an urgency that pushes them toward quick decisions, that pushes them toward bets, that pushes them exactly toward the behavior that keeps them far from the result they seek. It is an invisible trap built not by anyone outside, but by the very mind of the person inside it, and it tightens most strongly precisely when that person most needs to escape it. The solution is not philosophical. It is not found in a self-help book or in positive thinking. It is structural. It is about building a base that survives your own impulses, investing consistently, even when the amount is small, not interrupting the process at the first moment of turbulence, understanding that each month you maintain the position without destroying it is a slightly cooler summer, a small layer of ice that did not melt, that will serve as the base for the next accumulation. Buffett lived 93 years. He started investing at 11. That means he gave time 82 years to work. 82 years of ice base accumulating. No strategy in the world replaces this variable. But the conclusion here is not that you need 80 years to build something meaningful. It is that the earlier you start, and the longer you maintain without destroying what you have built, the more explosive the result is at the end. And the later you start with the correct mindset, the better that still is than never having started at all. The market does not reward the smartest. It does not reward the most informed. It does not reward the bravest or the boldest. It rewards those who stay in the game the longest without breaking. It is a race where the winner is not the one who runs fastest in the first meters, but the one who does not leave the track. And this is the moral lesson Buffett leaves, not as a formal teaching, but as the concrete result of an entire lifetime of consistent choices. Real wealth is not built in moments of brilliance. It is built in the silence of those who resist when they should give in, who remain firm when they should exit, who patiently accumulate while the world around them is wasting away. If you made it this far, you already have more clarity about money than most people who spend years studying the subject superficially. Subscribe to the channel, like the video, and leave a comment saying what you thought and which city or country you're watching from. This makes all the difference for the channel to continue bringing content with this level of depth.